Last week we discussed the nature of the U.S. economy and the degree to which it's overheating. We appreciated some of the moving parts. Today, we're going to dig deeper into the implications of this debate for policymakers, both monetary and fiscal, and also we're going to explore the implications for business leaders. And we'll perhaps find some points of agreement amongst our participants, understanding that our job is to help those managers who are tasked with managing scarce resources in otherwise intellectually challenging times. So, Greg, I want to turn to you then and give you an opportunity to speak on monetary policy. So, to what degree do you think current kind of Fed stance has maybe contributed to some degree to the overheating question that you've articulated? And what's the roadmap in your mind, the appropriate roadmap in your mind for them going forward, given these concerns?
Yeah, I mean, I think there is a strong case to be made that the Fed is behind the curve, and I think they're realizing that. I think they've had a fairly rapid change in policy stance that they've communicated over the last month and a half, 2 months now. One very simplistic way to look at it, but I don't think it's completely inaccurate, is just to say what is the real short-term interest rate right now? So economists believe that the actual driving policy rate is not the nominal one, but one that's adjusted for inflation. So effectively, we have an interest rate that's close to zero. The Fed suggested it might go as high as a whopping 1% this year based on their December meeting. And we have inflation that's 7%. So that puts us at a real interest rate of minus 6%, which would make it the most negative real rate in the history of the Fed funds rate. So it's potentially a very, very stimulative economic policy, even with the Fed changing stance, limiting QE, and starting to raise the short-term rate. If we go back and look at a Taylor rule model, which is sort of just a simple mechanical calculation that does a good job of characterizing historical policy rates, and you plug in a 4% inflation rate, you plug in a GDP gap that's 0 or greater than 0, and you plug in a real equilibrium rate of 1 or 2%, and you easily get a Fed funds rate that should be 5%, potentially as high as 10%. So it's pretty easy to make a case that the Fed could be seriously behind the curve. And how much do they contribute to where we are right now? I think they weren't certainly ill-intentioned in what they were doing. They were trying to make sure that we did have a solid rebound in demand. But because monetary policy works with a lag, they could have waited too long to kind of take their foot off the gas.
Response.
So I think that view of whether that the funds rate should be 5 or 10% is predicated on the kind of this current level of inflation continuing, and also predicated on the view that the kind of neutral interest rate should be, real interest rate should be 1 or 2%. And I have some questions about both. So the first is, let's just kind of go back on the real interest rate. So when we were at the Fed, that was kind of the standard model, that the real interest rate should be around 2, neutral inflation-adjusted interest rate should be around 2%. But recent history has shown, and there's been a lot of research on this, that the neutral real interest rate has fallen. And if we just look at what happened in 2018 when the Fed raised rates, their peak was 2.25% on the upper bound, 2 on the lower bound, and so an average of 2 1/8. So their peak was 2.25, and just at that level, with inflation running around 2%, so you had kind of just zero real or inflation-adjusted interest rates, and at that level, you saw the economy slow and interest rate-sensitive sectors such as housing take a hit. So the first premise is, does the Fed need to get to 2%, or is really 0 on an inflation-adjusted basis the right number of the Fed kind of having their foot off the gas, but not on the brake pedal, so kind of being in neutral. The second one is where you think inflation is going to go. So as I said, the Fed and the private sector should be very humble about their forecasts. But if you think that inflation is going to slow because of the factors that I discussed, increase in labor force, decent productivity, a shift in demand towards services, away from goods, then you could say inflation, as expectations are in the private sector, will fall close to 2% by the end of the year. And so if you do that math applied to the Taylor rule, you actually get that the neutral fund, that the funds rate should be around 1%, which is where the Fed is kind of currently predicting, or they've penciled in 3 to 4 rate hikes. Although there has been a more hawkish shift these days. So I think they're being careful to say we are watching this and making sure that everybody knows that if they need to be more aggressive, they will. The question that I have for Greg is, should we be going to 5% now in these circumstances?
Yeah, I mean, I think absolutely the Fed needs to start moving sooner rather than later, just because it does feel like even if we say that the neutral rate's 1% and we say inflation is what's implied by tips, which is about 2.75%, that still gets you to 2 or 3%. So we got a few hikes. Maybe we only need 3 or 4 hikes, but maybe they need to be 1% each. And we do one a quarter. And sort of see where things go with inflation. And if inflation really does abate, then you can stop, and you're not going to be at a ridiculously high rate. But it seems like doing a quarter point increase, each quarter starting in March feels late.
So let's transition from the monetary authority, the central bank, to the fiscal authority, the taxing and spending authority of this nation. And I think we can all appreciate the sizable effort that we've made as a nation. In fact, you could say the same thing about the globe abroad as well. I mean, we've seen fiscal support that has not been witnessed in generations, frankly, right? And so, leaving aside some of the political challenges of moving forward, and there are many, how important has the current level of fiscal support been? And is it appropriate to engage in additional multi-trillion-dollar efforts, given that there may be some risk on the upside of overheating? So I'll start with you, Gerald, and then let Greg chime in.
So I think clearly the level of support that we've had in the last year needs to decline, and it has and is likely to continue to do so. The question is, should we continue to have targeted support? Potentially politically difficult, but as I was saying, for folks that are hampered by COVID and the recent surge in Omicron, that can't work because of childcare, continuing extending the expanded child tax credit would have been beneficial in my opinion. So I think some targeted policies in the near term to kind of retain demand and in communities or for workers that have a harder time with COVID, I think should continue to occur. And that has long-term benefits because you keep folks engaged in the economy, you keep a roof over their heads, they're more likely to return to the labor force, you potentially give them options to continue to train online, all things that you could do that don't cost a lot of money, maybe cost up more political capital. I think those things would continue to be beneficial. I think you're asking a broader question about Build Back Better, and again, whether there are a set of policies, paid leave, long-term child care, that are beneficial to the economy, which I believe there are. I'm not saying all of them, but there are a set of policies that are beneficial to the economy and that we need to spend money on, but the spending is not likely to occur tomorrow or today with the economy, with a debate about the economy being overheated or not. So I think making investments in the future that don't cost a lot today are beneficial, and we shouldn't let kind of current concerns about the economy hamper our ability to make those investments that I believe are needed. So I think yes, tighten fiscal, but maintain support where needed, and also have long-term investments in the economy.
So views on fiscal policy to date and roadmap going forward in light of your concerns about overheating.
Yeah, I mean, I think as you noted, the amount of fiscal policy and fiscal stimulus that we had over the last couple of years was just unbelievable. The IMF estimates that it was something on the order of 25% of GDP. So they kind of looked across a broad range of developed economies to try to figure out how large the fiscal stimulus was. They found that the fiscal stimulus in the U.S. was the largest of any developed economy. So I think that in my view, excess demand that we have right now is in part driven by this very, very strong fiscal policy response. I think it was appropriate in 2020 to have a strong response, but I think we probably overdid it last year with the last round of stimulus at the beginning of the Biden administration. That's not to say there aren't valuable things that we can invest in. I agree with Gerald. There are some things that we can do. I think we just need to be very focused on this notion of what's going to impact demand and what's going to impact supply. So we should not be adding new fiscal expenditures on things that are going to increase near-term demand. That's going to risk further overheating the economy. We can make important investments in things that will increase supply, and I agree. If we can find ways of getting people back into work, providing solutions for childcare for people where that's keeping them out of the workforce, that's a way to increase the labor force participation. If we can provide ways to quickly upskill people so that they're better able to work in jobs and be more productive, that also increases the productive capacity of the economy. So we just need to be very, very thoughtful about what fiscal policy is going to do in the next year or two to make sure that it's focused on increasing productive capacity and supply versus exacerbating excess demand.
So I guess, let me follow up on exactly that. So components of this, and I think the most obvious one perhaps might be infrastructure that are really targeted on affecting potential GDP and maybe alleviating the concern that you've mentioned. I think that's relatively easy to unpack. There's things in the Build Back Better that are mixed, right? And so I don't know if we know what fraction of all of this expenditure is sort of about more temporary support and possibly affecting demand versus things that are deeper and affecting the supply and potentially not just alleviating sort of the short-term supply disruptions, but also helping potential GDP going forward. I mean, do we have the capacity to be that strategic, do you think, to tackle this?
It doesn't look like we do. And by we, I mean the political forces at work in the U.S. It does feel like there isn't a clear economic lens that's being used to evaluate this. It's being done more on ideology on both sides of the aisle, to be frank.
So, I mean, how do you see this distinction between tackling short-term supply considerations and clear long-term supply needs, depreciating assets we have, versus some of the other components, which may be motivated by the needs of Americans in struggle right now, as you've articulated, but still could have the danger of kind of boosting the demand and maybe pushing further on the overheating? How do you think about this?
I mean, I think this is where, again, if politically feasible, getting targeted policy, and some of it is also economically feasible. I mean, one of the challenges during COVID with providing unemployment insurance is we don't know who really works as a consultant, so files doesn't qualify for unemployment insurance, and so so we pushed a lot of money out because we didn't really have the means to know who was really in need. So that's a long-term kind of infrastructure, not infrastructure and physical infrastructure, but kind of government policy infrastructure. I think as being an academe, us providing support in terms of research on, what policies worked and didn't work during COVID. And I'll say when I was at Treasury in 2014, and we were looking at, anytime we were worried about the economy, we looked at the lessons learned from the global financial crisis and said, okay, here's the playbook that we learned. Infrastructure, you can't really, it's a long-term solution, it's not a short-term solution. Extended unemployment benefits can be very beneficial, but as we learned in this case, it has limits because of what we know. And so I think that's those are solutions that are, again, economically, good research and adjustments to our governmental, infrastructure and knowledge base could really go a long way. But politically, that's, it's much harder. I think that, as Greg indicated, things that we can do to help increase labor supply and make that labor more productive are really beneficial. There's been a lot of investment in technology, and a lot of that is complementary, but you need the skills to use that technology. And per your point, that one of the reasons why we might be seeing this K is because you have a set of folks that have been fortunate enough to have gained those skills, gotten those skills, gone to universities, gone to technical schools, and so can use the technology, and there are folks that don't. And so getting those folks that don't and raising the skills of all of us will be really beneficial and allow us to make those investments in technology and cause booms in productivity.
So I want to turn to the what to invest in, but I want to take this from the perspective of the business community and business leaders. So I think one thing we've all agreed upon here is the extent of the remarkable degree of uncertainty, right? It's almost like what a recent book is kind of called radical uncertainty. It's almost impossible to sort of fathom what the heck is going on in a way. But business leaders have no choice but to manage. I mean, they have to make decisions. They have to take risks. Paralysis is not, anything but silly risk-taking, right? So how should they position themselves in the face of these kinds of driving forces? And in particular, Greg, what sorts of investments should firms consider in capital, labor, whatever? How should they be thinking about making real business decisions in the face of some pretty complicated forces?
Yeah, I mean, I think there's kind of two ways we can think about it. One's financial policy that companies might undertake, and the other is sort of real investment in the business. The financial policy one, to me, is pretty simple. Right? Businesses need to be prepared for much higher interest rates. I mean, the risks are to the upside there, and it very well could be that we see much higher rates in a year or two than what is currently built into the yield curve. So to the extent that they can take advantage of what are still quite low nominal interest rates, and lock those in through financial policy, even if it's doing synthetic, floating for fixed type of transactions. It just seems like a very prudent risk management policy on the financial side. The real business decisions are probably the more difficult ones in the sense that, I think going back to the labor shortage, really double down on what you're doing to try to retain your existing labor force. Put in policies that are going to make them stick around, but also things that are going to invest in them as workers to make them more productive for you. And likely those same things will make them want to stick around. So we know that training programs are highly valued by existing employees that feel like the companies are investing in their human capital. So it's a great win-win for businesses to really take what in many cases have been economic windfalls from higher corporate profits in recent years, invest those back in the workforce for what would create a more durable and sustainable future for their business.
Thoughts on how a business leader ought to think about all of this?
So I generally agree with Greg. One question is, what the cost of taking out that insurance in terms of, doing a financial transaction. I mean, but I agree that long-term interest rates do seem very low and don't have a lot of inflation risk priced into them. I think I think the one thing that maybe I might advocate that Greg didn't mention is not being afraid to raise wages to get workers in the door, and I think that if you invest in technology, you'll get those productivity benefits from those workers, and so your unit labor costs, so the kind of productivity adjusted labor costs won't be that high. We've seen, especially on the low end of lower wage you see wages have grown very slowly over the last 40 years and haven't kept up with productivity. So perhaps this is an opportunity for workers, low-skilled workers, to kind of get a little bit of their share. I mean, you work at a McDonald's. McDonald's has made a lot of money by, off of you flipping those burgers because of the technology that they've invested into the firm. So perhaps you're going to, firms are going to, or workers are going to get a little bit of those wage gains because of the labor shortage, and maybe that's not a bad thing. And by, paying those folks, you might retain them. You may have less, less churn in the labor market, and that could have long-term benefits. I mean, clearly, businesses have to be careful about their costs, but their profit margins are quite high, and I think interest rates are quite low, so you can make those investments and perhaps kind of have win-win solutions.
So here's my final question for the day then, which is, given all this and what we thought about from the perspective of policymakers, from the business community, and sort of the data and what it speaks to, I think we can all hope that whether the economy is relatively overheated, and even if that's in a pervasive manner or not, some of these factors are indeed eventually going to start rolling off. Now, whether that's reasonably near term or we're talking about a multi-year process, I guess one thing I'm interested in, and I don't know that we'll know this, so I'm going to abuse a metaphor here a little bit and sort of imagine that the tide starts rolling back, and then we can really observe the damage that the storm has created. And so where is the scarring likely to be that is going to be with us? What's fundamentally changed or been damaged, regardless of the degree to which there's overheating or not? Like, at some point down the road, we're going to see what the consequence of all of this was. Mm-hmm. Well, what are your thoughts on that?
I think it's going to be people that are asset poor, right? So I think the people that are going to be facing permanently higher housing costs, don't have savings that benefited from the substantial gains we had in financial markets, right? There's a good chance that people who have a lower level of household wealth are going to end up even more disadvantaged than they were prior to the COVID crisis.
Thoughts on this, where the damage is hiding and will be uncovered?
I think one of my greatest concerns is the fact that we've had, in some respects, a K-shaped educational outcome as a result of COVID. I think folks that have been fortunate that they could move easily online and had the infrastructure in their house, had rooms that they could go to for their kids to study or have classes, I think are going to be, I don't think their education has been as good as it was if in person, but at least will have a limited impact. But if you didn't, and there are clearly segments of the community that had very significant educational challenges, I think there's going to be a very long-term scarring, and it's just going to make the issues that Greg mentioned even worse. The San Francisco Fed put out a piece of research. I had done some back of the envelope, and they kind of did something that confirmed it, that I think over the long term it potentially could cost 1/10 or 2 on long-term GDP growth, which seems like a really small number, but it really adds up to trillions and trillions of dollars of lost output. And for overall the economy, and then especially in a concentrated manner.
So I think one thing we can agree on is there's a lot of uncertainty that's surrounding this question, and a comprehensive answer to how overheated is the U.S. economy is going to remain frustratingly elusive for a while. And I want to thank our debaters for providing a framework to help us better appreciate what these moving parts are and to understand the complicated forces at work.